The Federal Reserve just did something markets did not expect. Not a rate hike, not a rate cut, something far more dangerous, uncertainty dressed up as control. Within hours, trillions in market value began to unravel. Semiconductor stocks, the backbone of the modern economy, started collapsing in real time. But while ordinary investors panicked and pulled their money out, one group did the exact opposite. They started buying with both hands. Why would anyone buy into a collapse like this? What do they know that the rest of the market doesn't? By the end of this video, you will understand the strategy and the warning hidden inside this crash. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious investors understand the strategic forces shaping the global economy long before the headlines catch up. If you are new here, we don't chase hype. We study patterns, history, and the quiet decisions being made behind the scenes. Decisions that eventually reshape markets, currencies, and the wealth of entire generations. Before we begin, we would genuinely love to know, where are you watching from today? Drop your city or country in the comments below. Over the years, this community has grown into something truly global, and it means a great deal to see just how far these ideas travel. It started with a press conference, nothing more. No surprise announcement, no shocking number. Just a man standing behind a podium, using words that sounded strong on the surface, but meant almost nothing underneath. Federal Reserve Chair. Kevin Wersch stepped up to speak, and investors around the world leaned in to listen. They wanted clarity, they wanted direction. What they got instead was something far more dangerous, confidence without substance. He spoke with a hard tone. He talked about controlling prices. He talked about taking action. He used the kind of language that, on paper, should have reassured the markets. But when people listened closely, they noticed something strange. He never explained how. He never gave a plan. He never gave a number they could hold on to. And markets do not run on tone. They run on trust. Within minutes, something shifted. Not in the stock ticker at first, but deep inside the bond market, where the smartest and most cautious money in the world tends to move first. Long-term yields, the kind tied to 30-year bonds, began to rise. This might sound like a small technical detail. It is not. When yields on long-term debt rise after a central bank claims it will fight inflation, it sends a quiet but powerful message. The bond market did not believe him. This is the part most casual investors miss. They watch the news, they hear the words, they assume the person in charge has a plan, but professional investors, the ones who move billions of dollars every day, do not listen to words. They watch actions. And in this case, the action was missing. This was not the first time something like this had happened. For months, there had been questions about how this Federal Reserve chair had been chosen in the first place. Long before he took the podium, there were reports that the person selecting the next Fed chair had made one thing clear. He did not want someone who would raise rates aggressively. He wanted stability, not aggression. He wanted someone who would talk tough, perhaps, but not act tough. And now, here was a Fed chair doing exactly that, talking tough, acting soft. The market began to sense the gap between what was being said and what was actually going to happen. And that gap is where fear grows fastest. By the following day, the effects were visible everywhere. Odds of a rate hike in the coming months, which had been rising, started slipping backward even after his firm words. Investors who had expected strong, decisive action began questioning whether the Fed had the will or even the ability to follow through on its promises. This is where credibility becomes the real story. Central banks do not just manage interest rates, they manage belief. When people believe a central bank will do what it says, markets calm down. When people stop believing, uncertainty takes over. And uncertainty, more than any single policy decision, is what truly frightens investors. By the afternoon, that uncertainty had a name. It showed up in falling stock prices. It showed up in nervous headlines. It showed up in trading floors around the world where professionals tried to figure out what to do next. But this was not happening in isolation. Other pressures were building at the same time. Oil markets were on edge because of rising tension in the Middle East. Certain sectors of the economy, especially technology and semiconductors, had already been running hot for months, priced for perfection, with little room for disappointment. So when the credibility of the Federal Reserve came into question, it did not just create a ripple. It created the spark that lit a much bigger fire. What happened next would move faster and hit harder than almost anyone expected. A wave of selling swept through the semiconductor industry, one of the most important corners of the modern economy. Fortunes would rise and fall within hours. Confidence would collapse in some corners of the market, while quietly, in the background, a very different kind of investor began to watch, wait, and prepare to act. Because for those who understand how markets truly work, a crisis built on uncertainty is never just a warning. Sometimes it is an invitation. By the time the selling truly began, it no longer felt like a normal market correction. It felt like something breaking. Semiconductor stocks, the companies that make the tiny chips powering phones, cars, computers, and almost every piece of modern technology, had been climbing for months. Prices had gone up so fast that even experienced analysts struggled to explain the numbers. Some stocks had doubled, some had tripled, and a few had climbed so high that their price targets kept getting raised, again and again, by analysts who seemed almost afraid to say the word enough. That is often how the biggest collapses begin, not with fear, but with excitement that refuses to stop. One company in particular had become a symbol of this excitement. Its stock had soared past $2,000 a share. Analysts were predicting it would climb even higher, toward $3,000. Investors who bought early felt like geniuses. Investors who bought late told themselves they were still early enough. Then, almost overnight, everything reversed. The same stock that had soared past $2,000 fell below $1,000. And after hours trading, it dropped even further, touching levels nobody had predicted just days earlier. It was not a slow decline. It was a free fall, the kind that leaves investors staring at their screens in disbelief, refreshing the page, hoping the numbers are wrong. They were not wrong. Other major semiconductor companies followed the same pattern. Some fell so sharply that trading had to be paused entirely, a mechanism known as a circuit breaker, designed to stop panic before it spirals completely out of control. In South Korea, one of the world's most important stock markets for semiconductor production, this safety mechanism was triggered not once, but multiple times within a matter of days. This was not a normal pullback. This was panic. And panic behaves in very predictable ways. When prices are rising, people buy because they are afraid of missing out. When prices are falling this fast, people sell because they are afraid of losing everything. Few investors stop to ask why the price is moving. They simply react to the fear in front of them. This is the part of the story that repeats throughout history, again and again, in almost every market crash ever recorded. The same investors who were celebrating at the top were now selling in a panic at the bottom, often at the worst possible moment. But not everyone was selling. Quietly, in the background, a very different type of investor began to behave in the opposite way. Instead of running from the falling prices, they began studying them closely. They looked at charts. They looked at historical support levels, points in the past where prices had once stopped falling and turned around. They looked at patterns that had repeated themselves during previous crashes, years and even decades earlier. To an outsider, this behavior might look reckless. Why would anyone buy a stock that just lost more than half its value in a matter of days? But to a disciplined investor, the answer is simple. Fear creates opportunity. When emotion takes over a market, prices often fall much further than the actual value of the company justifies. The business itself has not changed overnight. The factories still exist. The technology still works. The demand for semiconductors used in nearly every modern device has not disappeared. What changed was human emotion. This is precisely the moment that separates long-term investors from short-term traders. Long-term investors ask a different question. Not how far can this fall, but how far has this already fallen and does that create value? They look past the panic on the surface and try to see what lies underneath it. As the semiconductor sector convulsed and headlines grew louder with warnings of collapse, a quiet decision was already being made by those who understood market history. They began buying, not out of blind optimism, but out of careful calculation. They were not guessing. They were preparing for what almost always follows extreme fear in the markets, a moment that history has shown again and again, one that very few people recognize while it is happening. There is a moment in every market crash when the crowd goes silent, not because the danger has passed, but because most people have already given up watching. That silence is often when the real decisions get made. While headlines continue to warn of collapse, a smaller group of investors turn their attention away from the panic and toward the charts, not to predict the future with certainty, but to study patterns that had shown up again and again throughout financial history. They were not looking for hope, they were looking for structure. One of the tools they relied on was something called a retracement level, a way of measuring how far a price typically falls before finding support based on the size of its previous rise. It sounds technical, but the idea behind it is simple. Markets rarely move in a straight line. They rise, they pull back, they rise again. And within that pattern, certain price levels tend to act like invisible floors, points where selling slows down and buying begins to return. When these investors applied that thinking to the semiconductor collapse, something interesting appeared. The steep decline was not random. It was landing near levels that had acted as turning points before. Old resistance, gaps in price history, and long-term trend lines were all beginning to overlap in the same narrow zone. To someone unfamiliar with markets, this might sound like guesswork dressed up in complicated language. But to those who study price behavior closely, these overlapping signals are taken seriously. They do not guarantee a bottom. Nothing in markets is guaranteed, but they shift the odds, and shifting the odds is often the entire game. At the same time, a bigger and slower story was unfolding underneath the surface, one that had little to do with semiconductors directly, but everything to do with why investors were nervous in the first place. Government debt levels were climbing at a pace that concerned economists. Trillions of dollars were being issued each year just to keep the machinery of the economy running. Global money supply, the total amount of currency circulating through the financial system, was expanding steadily. And with that expansion came a quieter, more uncomfortable question that serious investors had begun asking for years. What happens to the value of money itself when so much of it is being created? This question is not new. It has appeared throughout history, in different countries, under different governments, always following a similar pattern. And when trust in a currency weakens, even slightly, investors begin looking for something else to hold their wealth in, something that cannot be printed, something that has held value across centuries, long before modern banking systems existed. Gold has often played that role, not as a flashy investment, but as a quiet form of insurance, something investors turn to when confidence in paper currency begins to erode. And in the background of this entire semiconductor story, gold was moving as well, responding to the same uncertainty coming from the Federal Reserve. This is where the bigger picture starts to come into focus. The semiconductor collapse was not just about chips and technology companies. It was a symptom of something larger, a growing unease about monetary policy, government debt, and the credibility of the institutions meant to manage them. For disciplined investors, this created two parallel strategies happening at the same time. On one side, they were buying beaten-down technology stocks at prices that reflected panic rather than fundamentals. On the other side, they were paying close attention to hard assets like gold, viewing them as protection against the deeper, slower risks building underneath the surface of the economy. Neither of these decisions were made emotionally. They were made by studying history and asking a simple but powerful question. What has happened in the past, when trust in monetary policy weakened, and how did investors who prepared in advance perform compared to those who reacted in fear? The answer to that question, repeated across decades of financial history, was about to become very important. Because what was unfolding in these markets was not an isolated event. It was part of a much older pattern, one that had appeared before, and one that history had already given investors a warning about. History does not repeat itself perfectly, but it often rhymes in ways that careful observers learn to recognize. And for those who studied the events unfolding around the Federal Reserve, the semiconductor collapse and the quiet rise in gold, this moment felt familiar. Decades earlier, similar patterns had played out. A central bank would speak with confidence, promising to control inflation or stabilize markets, only for investors to later discover that the words carried more weight than the actions behind them. Each time this happened, the initial reaction from markets was similar: confusion, followed by a sharp and sudden repricing of risk. In the late 1970s, for example, the world faced a period where inflation ran far ahead of what policymakers were willing to admit. Central bankers spoke about controlling prices, yet interest rates lagged behind reality for years. Investors who trusted the official message alone were caught off guard. Those who paid attention to gold, and to the growing gap between promises and action, protected their wealth far more effectively. A similar pattern appeared again in the early 2000s, and once more in 2008, when trust in financial institutions eroded almost overnight. In each case, markets did not fall simply because of one bad headline. They fell because confidence, once questioned, tends to unravel quickly. And in each of these periods, hard assets like gold moved in the opposite direction of panic, quietly gaining value as trust in paper promises weakened. This is the deeper lesson that repeats through nearly every major financial cycle. It is rarely the announcement itself that causes lasting damage. It is the growing distance between what leaders say and what they are actually willing to do. The events surrounding this Federal Reserve chair fit neatly into that same historical pattern. Strong words followed by hesitation, promises of control followed by a lack of concrete action, and a bond market that, time and again throughout history, has proven far better at detecting the truth than public statements ever could. What makes this moment especially important is the scale of the numbers involved. Government debt was not simply large, it was expanding at a pace that, according to many economists, could not continue indefinitely without consequences. Each year, trillions of dollars in new debt needed to be issued and absorbed by markets. Each year, the pressure on the value of currency quietly, methodically increased. Investors who studied these patterns closely understood something important. Panic in a single sector, such as semiconductors, often distracts attention from a much larger and slower moving story. While the crowd focused on falling stock prices and dramatic headlines, the real story was unfolding underneath, in bond yields, currency stability, and the credibility of the institutions responsible for managing them. This is why, throughout history, the investors who performed best during uncertain periods were rarely the ones reacting to daily headlines. They were the ones who had already prepared, months or even years in advance, by understanding these recurring patterns and positioning themselves accordingly. The events of this particular week were unlikely to be remembered as an isolated incident. Instead, they were likely to be viewed, in hindsight, as another data point in a much longer historical pattern, one where credibility, debt, and trust in monetary policy collided, creating both danger and opportunity at the same time. For those watching closely, the message was becoming increasingly clear. This was not simply a story about semiconductors or a single press conference. It was a story about how modern economies respond to pressure and how history, again and again, has rewarded those who understood the pattern early.